Is the crypto bull market in its final stretch? Are we just months away from the peak before a brutal bear market takes over? If you've spent any time in crypto, you know the playbook. Every previous cycle has lasted 4 years. And now that we're deep into year 4, one thing is obvious: we're much closer to the end than the beginning. In fact, many analysts believe the peak could arrive within the next 3 months because that's exactly what history suggests. But not everyone agrees. Wall Street veteran Tom Lee believes this time is different. He argues the bull market still has much further to run. From institutional flows reshaping demand, to looming stablecoin regulations, to leverage climbing to dangerous new levels, the stakes have never been higher. But is he right? Is this time really different? In this video, you'll hear Tom Lee's case for why this cycle may not end the way most expect, what could trigger the eventual turn, and how to prepare for the bear market when it finally arrives. And before we dive in, only a small percentage of you watching are actually subscribed. If you're getting value from these videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Let's begin with Tom Lee.
I think when people talk about a crypto cycle and it being 4 years, there's probably some reflexivity at work because the original genesis was that, Bitcoin had a halving cycle. And so people were talking about a price cycle that really followed a Bitcoin in a halving. But in crypto, as you know, because there isn't a company, it's decentralized, and there's no centralized source of information, price itself often becomes really important, especially in the early days. So I think that there was a lot to people looking at patterns and then markets trading on those patterns. And the reality is that it's still true in the equity world, because I can't tell you how many of our institutional clients still look at seasonality, which is just applying a calendar to what price action could be, either whether it's credit or volatility or equity. So every element of liquid markets today. I think that there is probably some credence because many people are positing that the 4-year cycle may not be in place anymore. Everybody from Bitwise, to David Bailey, so a lot of OGs. And that has to do with the fact that the incremental buyer of Bitcoin is no longer retail, which was really the story from inception up until probably 2024. And so now in the last 2 years, there's now institutional allocations taking place into crypto. And because of that, it's probably counter-cyclical.
People talk about the crypto cycle. The conversation almost always comes back to the 4-year pattern. Bitcoin halves every 4 years, supply gets cut in half, and prices eventually rip to new highs. That model has been the dominant framework since Bitcoin's creation, but Tom Lee, co-founder of Fundstrat and one of Wall Street's earliest Bitcoin bulls, argues the future may look very different. His point is simple: the players in this market have changed. In the early days, crypto was almost entirely retail-driven. Individual traders chasing momentum were the ones setting the pace. But since 2024, the buyers stepping in have been pension funds, sovereign wealth funds, insurance companies, and massive institutional allocators. That changes everything because institutions don't buy in cycles, they buy in allocations, they operate on multi-year horizons, and their behavior doesn't follow the same rhythm as retail speculation. This is where the bullish side of Lee's thesis shines. If crypto cycles were once about hype and crash, the next phase may be about steady flows and counter-cyclical demand. Institutions often buy during periods of weakness, not strength, because their models look at long-term value rather than short-term excitement. That creates a floor under the market that simply didn't exist in 2013 or 2017. Combine that with the trillions of dollars sloshing around in ETFs, private funds, and balance sheet reserves, and you get a structural bid that could keep this cycle alive far longer than skeptics believe. Even if the old 4-year cycle is losing relevance, the new framework isn't one of collapse, it's one of extension. As Lee puts it, reflexivity still exists, but the scale of money entering crypto has changed, and that means the bull market could stretch further, powered not by retail manias, but by institutional conviction. Before we can even begin to answer whether the crypto bull market is ending, we need to establish what the bull market actually is. This might sound basic, but in crypto, definitions are constantly debated. Some traders say the bull market starts the moment Bitcoin bottoms. Others claim it only begins once Bitcoin prints a new all-time high. Still others argue it's best measured against long-term moving averages rather than price alone. That lack of consensus is exactly what makes this conversation so difficult, because if you can't define the beginning, how do you ever know when it ends? Historically, Bitcoin's 4-year halving cycle has been the most widely accepted framework. Each halving reduces new Bitcoin issuance by half, tightening supply and eventually pushing prices higher. After that supply shock, demand typically accelerates, creating the bull run. But here's the nuance that many miss. The halving is not the cause of the bull market, it's the trigger. The true force behind the rally is human behavior, amplified by leverage and liquidity conditions. This is why past bull markets didn't simply move higher in a straight line. They exploded, collapsed, consolidated, and then surged again. Looking at past cycles, Bitcoin tends to top 16 to 18 months after a halving. The last halving was April 2024, which would place the expected peak on or before October of 2025. By that timeline, we could very well be standing right at the inflection point. But markets don't just obey calendars. A bull market is also defined by whether Bitcoin and crypto are trading above key long-term averages. One of the best examples is the Bollinger Band moving average on the monthly chart. When Bitcoin is above it, it's in a bull market. When it falls below, it's in a bear market. Right now, Bitcoin is still comfortably above this line, suggesting the bull run technically remains intact. But here's where things get complicated. Other parts of the crypto market, especially the Others index, which tracks coins outside the top 10, are much closer to their own Bollinger Band thresholds. If those fall below their monthly averages, they could signal weakness that bleeds into the broader market. In simple terms, Bitcoin is the leader, Ethereum follows, and altcoins are the caboose. If the caboose derails, it can drag the rest of the train with it. So is the bull market ending? Not yet. By the most widely respected metrics, the market is still running, but the margin of safety is shrinking, especially for smaller cap assets. The definition is critical because once you understand what a bull market is, you can start to identify how close we are to its conclusion. Let's address the elephant in the room. Predicting the exact end of a bull market is nearly impossible. That doesn't mean you can't get close, but the notion of nailing the top to the day is fantasy. The reason is that bull markets rarely end on technical signals alone. They end when a big external catalyst collides with stretched leverage. Take 2017. The run ended when South Korea announced it might ban crypto exchanges. In 2021, the peak coincided with the Federal Reserve signaling aggressive rate hikes to fight inflation. In both cases, the catalyst didn't cause the top, it accelerated a downturn that was already overdue. This is why Tom Lee and other analysts often emphasize reflexivity. When traders expect the top, their behavior shifts. Leverage builds, profit-taking increases, and it only takes one spark to set off a chain reaction of liquidations. What's unique about this cycle is that the list of potential catalysts is far larger than in the past. For example, the US Treasury is considering strict KYC rules for stablecoins with a decision window in October 2025. If passed, that would hit the market at precisely the time frame many expect a cycle top. There's also the geopolitical side. US-China tariffs could resume in November, and tensions around Taiwan have been heating steadily. Each of these events could act as a match in a dry forest. But here's where timing becomes so dangerous. Liquidation mechanics. Long liquidations on exchanges can create immediate crashes, but it's the DeFi and CeFi liquidations that cause sustained pain. When collateralized loans unravel, it doesn't happen in one day. It happens over weeks, sometimes months, as protocols slowly sell down assets to make lenders whole. This is what makes crypto so much harder to navigate than equities. In equities, sell-offs are brutal but quick. In crypto, forced selling can grind the market lower even when retail sentiment thinks the worst is over. And yet, despite this danger, trying to predict the exact day of the end is a fool's game. The better strategy is to watch for signs of exhaustion. Overbought RSI levels on monthly charts, altcoins failing to follow Bitcoin, and news headlines that look like they could trigger cascading liquidations. Each is a puzzle piece. Alone, they don't mean much. Together, they reveal when the tide might be turning. So with all of that context, where are we now? Are we approaching the end, or could this market push even higher before a real reversal? The data gives us a mixed picture. On the one hand, Bitcoin and Ethereum are still strong, trading well above their long-term averages. That suggests momentum remains alive. On the other hand, the altcoin market, especially coins outside the top 10, are showing cracks. Historically, altcoins peak last. When they start to falter, it's often a red flag. Yet, there's another angle we can't ignore: liquidity. In every past bull market, liquidity conditions have been central. Today, central banks around the world are quietly shifting from tightening to easing. The Federal Reserve has already pivoted away from rate hikes, signaling that financial conditions are softening. Add in the trillions of dollars sitting in money markets waiting to move, and the setup for another leg higher is real. In fact, some analysts argue that the real blow-off top hasn't even arrived yet, and that what we've seen so far is just the prelude. Think about it this way: retail mania has been relatively subdued compared to past cycles. Search interest for crypto is nowhere near 2017 or 2021 levels. Meme coin trading exists, but it hasn't gone completely parabolic. NFTs are active again, but they haven't hit the speculative frenzy of 2 years ago. All of that could mean we haven't yet seen the true excesses that typically define a cycle top. If that's true, then the end is not imminent, it's still ahead of us. So are we closer to the end or another surge higher? The evidence leans toward caution but doesn't scream collapse. The structural indicators remain bullish. The macro backdrop is supportive, and retail has not yet gone full tilt. That combination could mean this cycle has more room to run, even if the risk of an eventual reversal is growing by the day. So if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. We've now unpacked the catalysts that could ignite a downturn, the leverage that makes it deadly, and the automation that ensures the crash runs its course. But the next question is just as critical. When the bear market does finally arrive, how do you know where the bottom is and how low could crypto really go? That's what we'll break down next. Every bull market eventually collides with something that shifts the narrative. It's rarely just price exhaustion. It's usually a catalyst that investors weren't pricing in. In crypto, these catalysts have historically been game-changing announcements or policy moves. In 2017, it was South Korea proposing a ban on exchanges. In 2021, it was Jerome Powell signaling aggressive rate hikes. In both cases, the market had already run hot, leverage was stretched, and sentiment was euphoric. The news didn't create the top, but it accelerated a downturn that was waiting to happen. This is why watching for catalysts is so important in 2025. We're heading into a highly sensitive period for both macroeconomics and geopolitics. The US Treasury is considering new rules that could force all stablecoin transactions to pass through KYC checks. That may sound harmless at first, but in practice, it would shake the foundations of DeFi and significantly slow liquidity across exchanges. The timing is critical, with the comment period ending in October 2025, just as the halving cycle's historical peak window closes. Then there's the trade war angle. The US and China are sitting on a paused tariff agreement that could expire in November. If new tariffs are reimposed, global risk assets won't escape the fallout. Crypto, being one of the most liquidity-sensitive assets, would almost certainly take a hit, and if that weren't enough, Taiwan remains a flashpoint. Any escalation there would create uncertainty that spills into every asset class. For Bitcoin and crypto, which thrive on liquidity and confidence, those headlines could be devastating. But the nuance is that catalysts don't always kill the bull market. Sometimes they just create pullbacks that later recover. The key factor is whether leverage has already maxed out. If the market is loaded with debt, a catalyst acts like a needle popping the balloon. If the market is relatively underleveraged, the same headline may only create temporary pain. So while we can't predict the exact catalyst, we can monitor the state of leverage to assess how fragile the market really is. Now, if catalysts are the spark, leverage is the gasoline. Crypto bull markets don't die because of bad news alone, they die because traders are overextended. Every major top has been followed by a wave of liquidations, both in centralized exchanges and decentralized protocols, and the deeper you dig into this cycle, the more concerning the leverage picture becomes. On centralized exchanges, long liquidations are nothing new. Traders borrow to go long, prices drop, and automated systems force sell their positions. This creates cascades where one liquidation triggers another. But that's only the surface. The deeper threat lies in DeFi and CeFi borrowing. When large amounts of crypto are locked up as collateral for loans, a price drop doesn't just hurt traders, it forces protocols and lenders to slowly unwind massive positions. That means robotic selling day after day until the books are balanced. This is exactly what made the 2022 crash so brutal. Platforms like Celsius, Voyager, and Three Arrows Capital weren't just bad actors, they were leverage bombs. Once their positions cracked, the forced selling didn't stop for weeks. Fast forward to today, and the stakes are even higher. Institutions, treasuries, and large funds are now using similar strategies, only at greater scale. If a big treasury-backed firm is forced to unwind billions in Bitcoin or Ethereum, it won't be a one-day crash. It'll be a drawn-out grind that makes it feel like the floor is falling out from under the market. And this is where the timing matters. Leverage typically peaks near cycle tops because by then, everyone is convinced prices only go up. Retail piles into futures, hedge funds use crypto as collateral, and even corporate treasuries take on loans against Bitcoin or Ethereum. When a bearish catalyst arrives at that exact moment, the dominoes start falling and there's no dry powder left to buy the dip. The crash feeds on itself until forced sellers run out of assets. The harsh truth is this: bull markets end not when optimism fades, but when leverage collapses. Traders always think they can ride the wave out, but when you borrow against an asset that drops 20%, you're liquidated, period. And this cycle has more potential leverage than any cycle before it. In traditional finance, panic selling is largely emotional. Humans sell because they're scared, and they can sometimes be reasoned with or step back when they see value. In crypto, that human element is disappearing. The rise of automated liquidation systems in both DeFi and CeFi means that when prices start to fall, algorithms take over. They don't hesitate, they don't second guess, and they don't stop until every position is liquidated. This automation is what makes modern crypto crashes so devastating. In 2022, we saw how liquidations in DeFi protocols like MakerDAO or Aave created robotic waves of selling. The collateral didn't care that Bitcoin was undervalued at $20,000. It just sold to make lenders whole. Today, the same risk is multiplied because the scale of DeFi has exploded and more institutions are using crypto collateral than ever before. Another layer is the rehypothecation problem, where the same collateral is used multiple times across different platforms. When one protocol sells, it creates ripple effects on others that also depended on that collateral. This creates chain reactions that are impossible to stop in real time. And unlike human-driven sell-offs, these don't burn out quickly. They keep grinding lower until the system is purged. But even here, there's a bullish silver lining. While automation makes the crashes more severe, it also creates cleaner resets. Once the liquidations are done, the market is free of weak hands and over-leveraged players. That's why some of the best buying opportunities in crypto history have come in the wake of these collapses. Investors who can stomach the carnage and step in when everyone else has been forced out are often the ones who capture life-changing gains in the next cycle. The hardest part of every crypto cycle is buying even when everything looks broken. History shows that the bottom doesn't form when people are celebrating. It forms when despair is everywhere. But the challenge is that you'll never know it's the bottom until after the fact. Still, there are tools and indicators that can help you get close. One of the most reliable is the Relative Strength Index on the monthly chart. In past cycles, Bitcoin has bottomed when RSI hit roughly 40 on the monthly time frame. While it's not a guarantee, it's definitely a strong historical signal. For example, in 2018, RSI touched the low 40s before Bitcoin bounced from $3,000. In 2022, the same thing happened near $15,000. Each time, RSI told us the market was deeply oversold. Another signal comes from sentiment itself. In crypto, extremes matter. When everyone on Twitter is calling for Bitcoin to hit zero, when mainstream news declares the industry dead, when even longtime believers start to give up, that's usually when the bottom is near. In December 2018, headlines about Bitcoin being a failed experiment were everywhere. That was the exact month it bottomed. In November 2022, after the collapse of FTX, sentiment was apocalyptic. That was also the bottom. But sentiment isn't enough. You also need to look for the final liquidation event. Every cycle seems to have one. In 2014, it was Mt. Gox. In 2018, it was a wave of ICO projects collapsing. In 2022, it was FTX and Three Arrows Capital. This cycle could be a big crypto treasury firm or even a stablecoin issuer under stress. These events create panic, but they also wipe out the biggest over-leveraged players. When that happens, the market finally has room to rebuild. If you can combine RSI, sentiment collapse, and a major liquidation event, you're probably staring at a generational buying opportunity. The challenge, of course, is having the courage to act when the fear is at its highest. The next question is just as important: how low can prices realistically go? Let's start with Bitcoin. In every past cycle, Bitcoin has never fallen below the previous cycle's top. That's a remarkable pattern, and it has held true through multiple brutal bear markets. The previous cycle's top was around $69,000 to $70,000. That suggests Bitcoin's bottom this time could be in that range, plus or minus $10,000 depending on the severity of liquidations. That means somewhere between $60,000 and $80,000 is a realistic floor for Bitcoin. That may sound high compared to past cycles, but it reflects the maturity of the market. Bitcoin is no longer a fringe asset. It's a multi-trillion-dollar instrument with ETF flows, institutional buyers, and corporate treasuries. Those players are unlikely to let it fall back to the old days of $20,000 or $30,000. The new floor has shifted upward. Altcoins, however, are a different story. They don't have the same structural support. Many altcoins historically lose 90 to 95% of their value from cycle highs. That's not an exaggeration. It's what we saw in both 2018 and 2022. The harsh truth is that most altcoins are driven by speculation, and when liquidity dries up, they get obliterated. The survivors often become the next cycle's leaders, but picking them in the middle of a crash is almost impossible. However, Ethereum may be the exception. With ETFs on the horizon, massive developer activity, and dominance in DeFi and stablecoins, Ethereum has real staying power. If Bitcoin bottoms around $70,000, Ethereum might find support somewhere near $3,500 to $4,000. Still painful, but not catastrophic. For everything outside the top 10, investors should expect brutal drawdowns. If history repeats, the majority of altcoins will never recover their cycle highs. So how low can crypto go? Bitcoin probably won't fall below $60,000, Ethereum may see the 3,000s, and altcoins will face their usual devastation. For disciplined investors, that means focusing on assets with structural demand and being wary of chasing speculative plays that may not come back. Here's the good news: bear markets don't last forever. They cleanse the market, shake out the weak, and set the stage for the next bull run. If Bitcoin peaks in late 2025, history suggests it could bottom in late 2026. That would give investors about a year of consolidation before the next leg higher, but preparation has to start now. The first step is position sizing. If you're fully deployed at the top, you won't have cash left to buy the bottom. Smart investors always keep dry powder. That doesn't mean selling everything now, but it does mean planning for a scenario where prices fall 50% or more from current highs. Having capital ready to deploy in those moments is how fortunes are made. The second step is knowing what to buy. Bitcoin is the safest play, Ethereum is the second, and beyond that, only a handful of altcoins with real adoption will likely survive. History shows that chasing hype coins in the late stages of a cycle is financial suicide. The projects that dominate the next cycle often aren't even on the radar yet. Focus on the assets that have proven staying power. The third step is managing psychology. Bear markets feel endless. They grind for months with small rallies that suck investors back in before punishing them again. If you know this ahead of time, you can prepare emotionally. The people who survive bear markets aren't necessarily the smartest, they're the ones who stay disciplined. Finally, remember that every bear market has been followed by a bigger bull market. In 2013, Bitcoin topped at $1,000, then fell to $200. People said it was dead. In 2017, it hit $20,000, then fell to $3,000. People said it was dead. In 2021, it hit $69,000, then fell to $15,000. People said it was dead. Now, we're talking about possible bottoms near $70,000. That's the long-term trajectory. The details of each cycle change, but the direction remains the same. So where does that leave us? The bull market isn't over yet, but the risks are growing. A catalyst could spark liquidations, leverage could magnify the damage, and automation could grind the market lower than anyone expects. But when the dust settles, history suggests crypto will rise again, bigger than before. The real challenge isn't predicting the exact top or bottom, it's surviving the storm long enough to see the next boom. Anyway guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.